Right, here we're going to walk through a commodity CFD trade. You really want to get your head around, obviously, the functionality behind it. More importantly, commodity CFDs do vary a little bit from a standard, let's say, equity CFD or Forex CFD, but they are very similar to index CFDs, and it all comes down to contract specs, which is going to affect your exposure, which you need to understand before you trade commodities. So in this case, we're going to trade WTI crude oil, which is West Texas Intermediary crude oil. Probably the most popular of the crude oils that's traded. Most of the times you hear the price quoted, it will be WTI. It's 1,000 barrels. A contract is standard. There are minis of that, I think, of 500 barrels. Some market makers then offer as little as 25 barrels, something along those lines. And it trades in US dollars. Okay. Now, in this case, we're going to open our position, the purchase price at 80 US dollars. Now, where we need to be careful is while we're only buying one contract, that spot price they quote is on a per barrel basis, okay? It's not per contract. So that contract you're buying is not trading at $80. It's trading at $80 a barrel. And as we just discussed, there are 1,000 barrels to this contract. Therefore, your gross exposure is actually going to be 80,000 US for this one contract, okay? So every cent movement is going to be $10, plus or minus $10 to your P&L, okay? Each dollar movement, as you'll see, will be $1,000, okay, because it's per barrel. Now, our gross exposure, 80,000. I trade with a DMA provider, so it's per contract. I get a flat fee of $10. It will vary. Market makers will widen the spread on the contract, and that's how they make their commission. My margin, 3%, so $2,400 isn't bad for an $80,000 exposure. Again, all in US dollars. So therefore, our initial outlay is the $2,400 for margin plus the $10 for commission. Our closing price, we hold it overnight. Let's say it's gone up $1 to 81 US. Again, we're going to sell one contract, okay, because we're only holding one contract. The value of the position's gone up to 81,000 because of the extra dollar. So the extra dollar per 1,000 barrels obviously equates to $1,000. So it's gone up 1,000. Again, it's $10 flat fee to jump out. The provider I trade with, because being DMA will not charge you financing on this, because the underlying futures contract doesn't incur financing either. Market makers will tend to charge you financing for smaller positions and so forth. Total outlay in the end is only $2,420. Gross profit is $1,000. So take off the $20 all round for commissions, and it's a lovely $980 comp on that one trade, which is 40.5% return on our investment, or our initial outlay, basically, of the $2,400. So that's how that works. Keep in mind, all commodity products, and literally all commodity products, are going to have contract specs like this. So gold's going to be 100 ounces. So if gold's trading at 1,300 US, it will be per ounce. So if there's 100 ounces and it's trading at $1,300 an ounce, your contract size or your position size, your exposure, is going to be 130,000. All right, a mini might be 30 ounces. It's going to be the same for any agriculture. Will be in weight denominations. Precious metal will also be in weight in ounces, gold, silver, copper. As we can just seen here, oil is in barrels, etc. Okay, so always keep that in mind when trading commodities. Always make sure you know your contract specs before you trade.